Good afternoon, everyone. Thank you for coming to the webinar. I just want to first find out if everybody can hear me okay. If you can hear me okay, you could just say yes if you hear me okay. Okay, great. Thank you. Okay, just a little bit about myself. My name is Mark Sachs. I'm here with RightLineTrading. I'm a graduate of the University of Pennsylvania and a former professor at Jefferson University in Philadelphia, PA. I've been involved in the financial markets for over 20 years. And if you could just excuse me for 1 second, I apologize. Just 1 second. And I began trading the futures and Forex markets about 10 years ago. And during my college and postgraduate years, I was involved in the optimization of software systems. And back in my postgraduate years, what I was involved in for my thesis was the optimization of multivariable equations using computers. And back then, that was a really giant leap forward in determining an optimized solution for a multivariable equation. What I looked at specifically was a program called ASOP, which is the Automated Engineering and Scientific Optimization Program, and it was developed by the Navy. And what we utilized it for was to optimize deep water dives. When a diver goes to extremely deep depths, as the diver comes up, to avoid decompression sickness, the diver has to continually switch oxygen mixtures, the oxygen, nitrogen, and then there's another third inert gas that is used. And as the diver comes up, these three oxygen mixtures have to equilibrate with the diver's blood in order to avoid the diver getting the bends. And the way that was done in the pre-computer optimization era was just simply by trial and error. And 30 years ago, it was a big leap forward to take all the parameters, or all the physiological parameters that are major independent variables, determine a multivariable equation, place it into a computer, and then optimize these deep sea dive decompression schedules via the use of optimization software. So when I founded RightLineTrading, I looked at the markets as no different than a deep water dive. The solution determining future price action is simply the end result of a complex multivariable equation. And what our goal is, or our job is to determine what those major independent variables are, place them in an equation, and then optimize them using specific types of software. Now, the thing that's really unique to day trading stocks, determining stock direction, is that traders utilize software, they utilize indicators, and they utilize trading methodology that's different than in any other industry. I mean, most of the stuff that we do. Now, a lot of people trade with price action and they don't use indicators. But if you use any indicator analysis, The reason you probably use that indicator is because you've been told by someone before you that the indicator is effective in predicting future price action. Now, the person who told you that probably got that information from the person before him and the person before him. Now, if you do a Lexis search, which is a world search in multiple languages, for any scientific papers that have been published to look at the actual statistical validity of any of these indicators in predicting future price movement, you'll find that there's almost nothing. In fact, there is nothing. So essentially what we're doing to trade, the information that we get off of indicators is really based on data that's no one ever proved to be, that no one has ever proved to be accurate. And that is why I believe that 95% of day traders continually fail. 95% of swing traders continually fail. And that's because each generation of traders continues to use the same indicators and the same strategy that was used by the traders before them to predict future price movement, and nobody questions the validity of any of the software that they're using or any of the trading strategies that they're using. I mean, just consider another industry, such as medicine or as architecture. If we dispense medication or build buildings based upon what we thought was true but not proven to be true, we'd have collapsing buildings and we'd have dying patients. And that is why we have the incredible failure rate that we do in this business. Now, we are essentially trading against other commercial traders, and we are trading against the big institutional traders. We cannot beat the institutional traders. What we have to do is we have to beat the other commercial traders. And there's no reason why we can't do that. We do it in the trading room every single day, almost every single day. And we do it every single month, and we've done it every single year now for 3 years. Now, there's no reason why those of us who look to trade stocks, determine stock direction, can't also do that as well. So let's just take a look at one theory that I wanted to show you, and to have you realize something. When somebody's marketing a software package to you, or even a friend, in best of hope, provides you with some information, it's like that the supposed guru who's selling you the software and your friend likely received the information he's telling you from another friend, and they really are not quite sure if anything that they tell you is accurate, and that includes the software guru. Now, if you look at an oscillator, whether the oscillator is stochastic, whether it's relative strength, whether it's the CCI, the stochastic is a pretty elegant indicator, and supposedly it's supposed to indicate an overbought or oversold market. But it's placed in software packages, and expensive software packages, and proffered by lots of people, even when they're trading Renko bars. And the reason they do that is they don't look at the underlying formula for a Renko bar, for an oscillator, excuse me. Now, when you look at the formula for an oscillator, you know that it requires 4 numbers. It requires the open, the close, the high, and the low of each formation. The formation could be a candlestick, it could be an open, high, low, close. The type of formation that you trade with is irrelevant. If it doesn't have those 4 numbers inserted, if it doesn't have those 4 numbers in each formation, then the oscillator indicator cannot trace out an accurate percent K. And let's take a look. This is just a regular range chart. And this is a futures chart, but it doesn't make any difference whether it's futures, whether it's stocks, whether it's Forex. This is just a range, 8-range chart. And this is tracing out an appropriate percent K line. To the extent that it's effective, it does produce an appropriate percent K. Now let's look at the same chart on a Renko. You can see that the Renko only has 2 of the 4 numbers required. It has a high and a low, but it doesn't have an open and a close. So the percent K is inaccurate. It is not tracing out an overbought and an oversold number. All it is simply tracing out the exact formation of price. It is giving you no information in any way that could potentially be effective in making a prediction about future price movement. This is why you have to be careful about any strategies that you use, and you have to thoroughly understand the underlying principle of each indicator that you place into your strategy, or evaluate the software package that you may potentially be buying or formatting yourself. Now, here's really probably the most important thing. Somebody invented the oscillator, and I do not remember who it is, but half the people who trade an oscillator trade it one way, and half of the people who use it traded it in a different way. Now, half of the people use the oscillator to tell them when the bulls are in control and when the bears are in control. Now, when the oscillator moves into the overbought zone, what they do is they continually to buy upside pivots as they're broken with a tight trailing stop. So they use the oscillator to tell them when to continue to go long. The bulls are in control here. Then you have another group that use an oscillator, in this case relative strength, to look for oscillator divergence, where price makes a higher high, but the oscillator makes a lower high. And they look to short the market off of the oscillator signal. Now, we all know, if we've tried to use this with stocks, that stocks will overrun this signal many, many times. So what we did was we placed this in we looked at 2 years of market replay data, and we looked at the validity, the sensitivity, specificity, and positive predictive value of the oscillator signal. And what we found is that the oscillator has no predictive value in determining future price movement. And probably the first scientific investigation of the value of an oscillator that, as far as I know, has ever been done. So we have removed the oscillator altogether as an indicator helping us to predict in which direction to go, whether future price is going to go up or whether future price is going to go down. And essentially what we have decided and what we have determined mathematically is that the oscillator is not an independent variable in our equation to determine future price movement of any market. Now, Fibonacci is another indicator that people swear by. They use it to predict future price movement of stocks, Forex, and futures. And Fibonacci was a mathematician who I believe lived in the 17th century. And at the time that he developed Fibonacci numbers and Fibonacci transformations, there was no stock market. And Fibonacci itself, the numbers, the extensions, the equations are really quite elegant, and they're really neat to work with if you look at some of the mathematical modeling they do. But in nature, they're pretty useless. They predict the number of edges on a pine cone, and or the number of ridges on a pine cone, the number of edges on a snowflake. But they really don't predict anything of major value in nature, like some of the major equations on quantum mechanics that predict how small bodies interact and large bodies interact, some of the really important theories in physics. Fibonacci doesn't predict anything. So what's some bright guy, whose name we don't know, decided to look at Fibonacci and see if these extensions and retracements determine future price movement in a financial instrument. Again, it doesn't make any difference whether it's stocks, futures, or Forex. And some people swear by Fibonacci. So what we did is the same thing. We did 2 years of market replay data. Now, on that 2 years of data, we looked to see if Fibonacci actually predicts areas of support, areas of resistance. And what we found is that the variability in these areas holding and breaking is so great that Fibonacci is another indicator that has no positive predictive value in determining future price movement. So we booted that out. It also is not an independent variable in an equation that you look to optimize to determine future price movement. We didn't accept a priori what everybody else tells us to be true. A lot of people tell you the oscillator is a great indicator. We've proven that it doesn't have any, it's not effective. A lot of people tell you that Fibonacci is a great methodology for determining future price movement. We determined mathematically that it doesn't work. And more recently, and I think many of you may be surprised, what we looked at was we looked at the MACD. And surprisingly enough, the MACD I thought was going to have some validity in predicting future price movement, and it does not. A MACD crossover, we looked at one MACD crossing over on your trading chart. We looked at multiple MACDs being driven by higher time frames. We looked at a combined total of 4 MACDs, all projected onto your trading chart. And in no way did the moving average convergence divergence indicator increase the precision of trading. It had no validity whatsoever. So we've also eliminated the MACD. So what we've done is we've eliminated almost every traditional indicator that people use to determine price movement. And again, we've come up with a new trading paradigm because our multivariable equation has kicked out what we now know are dependent variables. The oscillator is dependent upon some other set of variables. The MACD is dependent upon some other set of variables, and Fibonacci is dependent on other sets of variables. They're not independent variables, they're dependent variables. And in that kind of multivariable equation, you don't want dependent variables, you only want independent variables. So what ultimately we came up with is what is the predictive value of any indicator that assimilates data from your trading chart only? And the answer to that is 0. If the indicator is being driven by price on your trading chart, think about it. How can that indicator predict future price movement if it's being driven by price coming directly off your trading chart? It's not possible. And this is one of the reasons why 90% of day traders fail. They'll use a MACD crossover that occurs on their trading chart. That crossover has no statistical validity in determining future price movement. an overbought, oversold indicator on an oscillator, or they'll use Fibonacci being driven by price on their trading chart. All of these are not independent variables, and this is why so many people who trade stocks just are not successful. So what we did is we looked to see what indicators really are independent variables. What types of indicators actually drive price as opposed to price driving them. And one of those that we developed is called the bias indicator. Now, I am projecting slides for the futures market. When I show you the live platform in stocks, you're going to see that it really doesn't make any difference what instrument we project. It's true for whether you're projecting a slide on the futures or the Forex or on stocks. Now, what the bias indicator does is to determine the direction or the trend of the two higher time frame charts of the one that you're trading. Now, if you're trading a time chart, let's say a 3-minute, it's looking at the 9-minute, and it's looking at the 27-minute. And the logic of the indicator already assesses what those two higher time frames are based on the trading chart time frame that you choose. So it's looking at two higher time frames, and when all support to the down, it also looks at support and resistance. So when all support to the downside is broken on your two higher time frames, and your two higher time frames are trending to the downside, you get this pink color on your trading chart. And what this tells you is that your two higher time frames are strongly trending to the downside, and you have no support to hold up the market. So now you know, and so the price falls here and doesn't turn the background pink like almost all the other charts you see that have background bias or they have paint bars. Those paint bars turn red or the background bias turns red because price falls. That's price driving the indicator. This turns pink irregardless of how price acts on your trading chart. And price falls on your trading chart because your two higher time frames are trending down and all support is broken. And you're going to see over and over again that we have three different down strengths. There's pink, there's light pink, and then there's a teal color. They all present different trend strengths, all with bias to the downside. This bias is our strongest downside, and price falls because of the background bias. And this is a true independent variable. When this goes pink, you're looking for a short trade because your two higher time frames are heading down, and all support is broken to the downside. Now you're looking for an entry signal, but you are not going to trade the market long. Now, another independent predictor that we found is correlative markets. Again, this is the bond market, but it doesn't matter. Stocks have correlative markets. When some stocks go up, there's a handful of additional stocks that go up with a correlation coefficient of 0.7 or greater, and other instruments or other stocks that fall with a correlation coefficient of 0.7 or greater. So if there are 9 markets, if there are 6 markets, 3 and 3, each line contains 3 markets. Now these are other markets. If you're looking at Netflix, you're going to get one quant line because it's going to be assessing 3 other markets or 3 other stocks. It's really 3 other markets. We don't do an interstock analysis. We do an intermarket analysis. So 3 other markets are moving in an appropriate direction to determine that Netflix is going to go up. And essentially what you're looking at is if you look at the market this way, that there's a fixed there's a fixed dollar. It's not accurate entirely, but the concept is relevant and true. If you look at what's going on in the market on any given day, there's a fixed amount of money. And what the institutions do is simply rotate that money around. They rotate it between stocks, they rotate it between bonds and notes, they rotate it between treasuries, between precious metals, agriculturals, and even in the stock market. They rotate it between utilities and the safe havens versus some of the more risky tech stocks. So when risk is on, the more volatile and the more aggressive stocks are going to go up. When risk is off, there's going to be a move to ETFs. There's going to be a move to stocks that are safe havens, like precious metals, like utilities, like defense stocks, like Raytheon or Boeing. So essentially, what this is giving you is an indication of money flow. Now, in this particular instance, if this was a stock and risk was on, this would tell you that money is flowing from 6 correlative markets into stocks, specifically into this basket of stocks. And that because money is flowing into these stocks, you're going to see stocks rise. So stocks aren't rising and turning these 2 lines green. These two green lines are telling you that money flow is coming into the sectors, coming into the appropriate markets, that's going to push this stock to the upside. And it's a very precise instrument. It's a very precise indicator because the correlative markets we use and the correlative subsectors that we use to look at this are very, very precise. They have to have a correlation coefficient, again, of 0.7 or greater. Now here's a third, and very few, I haven't seen very many people use market profile in trading stocks, but it's a very, very effective indicator, and it really has a tremendous place in predicting future price movement. Now, what market profile does is it gives you a price that stock has the most volume at. It's really volume at price. That's the price where most traders like to trade the stock. And if you look at what is fair value for this stock, and you wanted to look at a number, that number where the point of control sits at is that price. That's where most traders want that price of the stock to be. So it acts as a strong area of support and resistance, and it also acts as a magnet. Since most of all the prices on the chart, this is the one price that traders like the most. It has the most volume traded. Now, if you take a bell-shaped curve in between these 2 magenta lines, 66 2/3% of all volume sits. So essentially, what the market is setting is a fair value for the price. And the fair value for the price is between the upper line, which is the value area high, and below the line, which is the value area low. That's where the market has said, I believe the stock is fairly priced within these 2 magenta lines. And I think the stock is optimally priced at the point of control. Now, when price breaks above fair value to the upside, first it's got to break through resistance to the upside. And then if it comes back and retests that area of support, it then can be taken as a long trade to the upside. The same thing with the downside. Here, price breaks below fair value, comes up above fair value, comes back, tests, and goes right up to the price magnet, the point of control. Now, volume profile is determined differently by different indicators. And what we've done is optimize volume profile. And you will find that volume profile helps you enormously in predicting future price movement. But there's certain factors involved in establishing the parameters by which volume profile traces out its lines, which makes one volume profile indicator different from another volume profile indicator. Remember that we don't believe that any indicator that uses price from your trading chart alone has any statistical value. So if we look at volume profile based on only what's going on in your trading chart, it's not going to work. And also remember, when the market opens at 9:30 a.m. Eastern Time, you don't have any volume traded yet, or you have very small volume traded on stocks. So the value area high, the value area low, the point of control, and the fair value for the stock really haven't been established, but the indicator is projecting. But it's projecting on almost no volume, total volume. So what we did, so a lot of indicators just open with the day's volume, and these areas have little validity. So what you need to do is do a proprietary look back. Look back a certain number of days as to where fair value has been to give weight to this indicator. Now, the number of look back days is proprietary, and it took us a long time to determine it. You look back too many days, then the indicator becomes slow moving, and it's like trying to turn a battleship. If you just look at it from data on your trading chart, for the first couple of hours, it's like a little rowboat. These value areas and point of control get buffeted around by just the smallest change in volume. So you want to stabilize these lines and give them validity. And that's what we've done. In addition, this market profile does its calculations inter-candle, which is really important because sometimes market profile will change on candle close. So you've found an entry, and the entry looks great. You've placed your buy or sell order in, and then as soon as the candle formation closes, market profile jumps in front of the trade, and the trade triggers, and you're in it, and you bang right up against the value area high, value area low point of control, and you wind up taking a losing trade. This calculates intra-candle. So you're not going to get that bump into your trade just as the trade triggers. Now, the other thing in helping us to assess a trending market is we have a proprietary modified 15. This is really R15. It's a 15-period moving average, but it's not an EMA and it's not an SMA. If you put the exponential moving average over it and you put the simple over it, you'll find out that they crisscross around it. And what we've done is we've put it in to establish maximum stability. So when you get a move to the downside, when the 15 and the 50 are both moving to the downside, you really are in a very significant downtrend. Now, another thing that our software does, which I don't think any other piece of software looks at, is it looks at market structure and price action. Now, when you get a period of consolidation, that's a very, very powerful signal that you want to trade out of. If you're day trading stocks, you look for consolidation, and you look to day trade out of consolidation. Now, when is consolidation likely to... First, let's talk about what's going on in consolidation. because this is really the nuts and bolts of day trading any financial instrument. What's happening is every time there's a down candle, you're getting traders stuck short. Every time there's an up candle in consolidation, you're getting traders stuck long. Every time another down candle, more traders stuck short, more traders stuck long, more traders stuck to the short side. So inside consolidation, you got a group of traders, and they're all looking for the market to break in their direction. And they know if it breaks in a direction against their trade, they are going to get stopped out. And that's very relevant to the consolidation signal and why it's so powerful. The reason being, first of all, is that consolidation, if the market is not overbought or oversold, is almost always going to break out in the direction of the trend. And we have a consolidation signal to tell you when to take a trade out of consolidation. It gives you the signal. You don't have to guess. We've defined consolidation. The software assesses it and gives you a signal. Now, the signal will always be in the trend, in the direction of the trend, but it's going to be when price is tight to resistance to the downside or tight to support to the upside. And you can see that these trades run a long, long way. These are where you can get your big runners, your 75-cent, your dollar runners on an instrument that's not particularly expensive. And that's out of consolidation, and the signal is given to you. Now, let me just say one thing about a trend. It's very, very, and I hope I'm not boring everyone, but this is the nuts and bolts of day trading. I mean, if you want a lot of fluff information about, people renaming indicators, I mean, like a Williams K is nothing more than an oscillator. It is not any more elegant than any other oscillator. The CCI also is just another oscillator. It is no more elegant or more powerful than any other. And people promote the Williams K, et cetera, whatever way the formula has been tweaked to determine market direction off of an oscillator. They're all basically the same, and they all have the same power, and we know that that power is zero. And if one Fibonacci line extension or retracement is not going to work, then Fibonacci confluences are not going to work. It doesn't matter whether you pile 25 lines on top of each other. If one line doesn't have validity, 25 lines on top of each other are not going to have validity. So this is the problem with day trading or even swing trading stocks. You can't look at what people have told you previously, or you're going to follow the trail of everyone previously, or 95% of those people, and that's going to be off a cliff. Now, it's very, very important that we trade with specificity, and I'm going to go over what specificity is in a minute, because you have to know these numbers to develop a trading strategy and determine what you're looking for and determine how to day trade or swing trade. And one of the things is to only trade a trending market. Now, sometimes a trending market is not as obvious as you may think it is, and a choppy market is not quite as obvious as you think it is. But making sure that you're in a trend is really essential to taking a trade. And you can see consolidation, as it breaks out of a trending market, will almost always break to the downside. Now, our software does an assessment of market structure, which is consolidation is a part of, and price action. Well, market structure is the 15 and the 50. Price action are the candles within market structure. Now, I'll just show you a couple of. So really, the goal of our software is to combine market structure on a multi-time frame basis, indicator analysis. Now, these are indicators that we know are powerful independent predictors of future market direction, all on a multi-time frame basis into a simple trading platform that's been optimized mathematically to provide you with really remarkably accurate trading entries. Now remember, if you can predict the future price direction of a stock, you can also very, very successfully buy an option, depending upon what your time frame is. Will depend on the time frame that you're looking at the chart. If you're looking to swing trade an option, you're going to look at a longer time frame. If you're looking to day trade an option, you're going to look at a shorter time frame. The rationale is absolutely the same. Now what I'm going to do is I'm going to go over to our actual charts. Now, I know this may be daunting to you, but what we have that I want to show you, now it's a dead market, and I can't really, so it's hard to show you this right now, but this is called our dashboard. Now, first let me show you a trading chart, and let's just go, let's just pick one. This is Garmin, and now you see what I've been talking about. In action. Now let's take 713 on Garmin. Let's take today. Now I'm looking for a perfect entry on Garmin. Now because these are all fractal indicators, they have to be reloaded. Now, here's a perfect short trade on Garmin. Now, let me show you what you have. The triangle is a consolidation signal. You can see the upper and lower bounds of consolidation. And you can see that the trend is clearly defined. The 50 is down. The 15 is down. And you see the background color is pink, which tells you, I'm not going to go in this webinar into the meaning of the different down colors, but tells you that bias is to the downside. The quantitative markets, and that is the correlative markets, are telling you that risk is off, that people are moving to markets that are going to pull money out of the basket of stocks that Garmin sits in. Now, Garmin is an engulfing candle, and it's overrunning all the buyers in B. Remember, I told you the software does an analysis of market structure, and these are all buyers that are trading in a counter-trend direction. So we're trading in the direction of the trend, we overrun them, and the trade is pushed down by two forces. One, the addition of new sellers, and one, by all the traders being stopped out in the B candle. Now, depending upon your risk tolerance, you can take the trade off at support, which is the value area low, or let the trade run all the way to the bottom and close at your first reversal. You're going to have to determine how far you want the trade to run. We have an ATM that we recommend, but you can see you get a nice short trade when everything aligns. Now the candle is surrounded in pink, and that means that order flow, which is another powerful independent variable, and momentum are also aligned to the downside on multiple higher time frames. So all you have to do is wait for an alignment of all the independent variables to get into a short trade on any given stock. And you can see these. There was only one perfect entry on Garmin for the day. And let's take a look at Netflix. Now we've got entries, but I'm looking for a perfect entry. And here's your perfect entry long. Right here. A move up, a pullback to retest support. Remember I said when you break out of the value area high, it will come back to the value area high, retest, and move up. It moves up on an engulfing candle. Correlative markets are telling us that money is flowing into stocks, and specifically into the basket of stocks that Netflix sits, and even into subsectors of stocks that Netflix sits. And you're going to get a decent move to the upside. Not a huge move. Now again, as long as background bias is green and the quant line is green, you can continue to hold. It really depends on your risk tolerance and your ATM, automatic trading management schedule. The point is, you've got a perfect entry and you've defined a perfect direction, and that direction is long. You are not going to trade Netflix to the short side here. Now, this is a nice move to the downside that I would take, but this takes a little bit more work for this. But here it is again. Here's your signal. Right here. At a consolidation, background bias is green. We know that multiple higher time frames are aligned to the upside. We know that all resistance to the upside is broken. And again, this is really important. The correlative markets are pushing money into Netflix and its subset of stocks. Risk is on. Money is coming out of bonds, coming out of notes, coming out of precious metals, coming out of agricultures, coming out of currencies. And it's not going into utilities. It's not going into the very conservative stocks. It's going into tech. So we know that money flow is moving in the appropriate direction, and we get a really nice move up on Netflix. Now the important thing is that you want to trade with specificity. And I don't want to run over time, but let me just give you a quick analysis of what sensitivity and specificity is. Because this is how you have to trade. Sensitivity, and I want to do this very quickly. Sensitivity is true positives over true positives. And if you understand this, you're going to understand how to day trade, plus false positives. Now, somebody who trades with sensitivity is trying to get into every single trade that moves, say, a candle or two. They're trading with a very sensitive trigger. I mean, they want to click that mouse on every move they think is going to be successful. The problem is they're going to pull in a lot of false positives, and they're going to get stopped out. Now, if the false positive rate was 0, the sensitivity would be 100%. You don't want to trade with sensitivity. What you want to do is trade with specificity. And with specificity, you're looking at the number of true negatives. What you want to do is you want to filter out the losers. Because if you do, you're going to trade successfully. Now, when you filter out the losers, all the true negatives, you're going to get some false negatives. And the false negatives are going to be the trades that all your variables have not aligned. There's no entry for you on this stock, but the stock runs anyway. And you sit there and you moan and groan about it, and you say, God, I missed that big move. Well, if you trade with specificity, you can't care about the big move. You have to let the market run when it doesn't meet your criteria for an entry. If you don't trade that way and you trade with sensitivity, you're going to suck in a ton of false positive moves or losers. When you trade with specificity and wait for the market to come to you, you know what you need. You need background bias to align. You want the candle to be surrounded by order flow and momentum. You want the quant line to be in your direction. You want a system-generated entry. We have a strategy entry. We have a consolidation entry. We have a C candle entry. You want one of those entries. When those things don't happen, you just wait. Because here's the kicker. The positive predictive value or your success rate. What is the value of an entry? What percentage of your entries is going to be successful? It's sensitivity over specificity times a very, very important number, and that number is prevalence. Now, when is it most likely for you to get a trade that trends? And prevalence is always highest when you have a trend. If you trade a choppy market, the prevalence of a big move is going to be low. When you trade a trending market, the prevalence of a successful trade is going to be high. So you trade with specificity, looking for the market to align in your direction, and you just wait and cherry pick, and you only trade a trending market to maximize prevalence. Then the positive predictive value that you're going to trade with is going to be exceedingly high. I mean, it's going to be 75 to 80%. 8 out of 10 of your trades are going to win, as long as you wait for everything to align and don't chase bad trades. That's really the key to trading. The over-traders, the traders that want to be in every successful move, and the traders that use independent variables that don't have any value are never going to be successful. And we can look at another stock. And I just put these up. I wanted to get a whole bunch of different stocks. Let's look at Apple. And look at the trade on Apple we had today. Now we always have to move to the right edge to determine where everything is. Now this is a tough trade. It's at a consolidation. You see the triangle, but it doesn't meet our criteria. We have upside resistance. That's the point of control, and that's a pivot. So we just wait for it to clear, and it clears right here. And look how far of a trade we get on Apple. That's a huge trade. Now, this is a very quick chart on Apple. Apple really shouldn't be on an 8 range. It should be on a 13 range. And you're going to get much, much bigger moves because you see Apple's not done. And you could take Apple all the way to here if you have a longer-term time frame. This is a range chart, but if you have a bigger range bars, it's going to go higher. The key, though, is your entry with the quant line showing that money is coming into Apple. You've got your trend. The 15 is up. The 15 is up. And you've got your stellar background bias. And you've got yourself really a huge trade on Apple. Now, if you trade in the direction of the trend with green background bias and the quant line in your direction, you're very, very, very unlikely to take a loser. Now, here's what we've done to make trading easier. We've created a dashboard. Now, this dashboard is not set up, but what it looks at is background bias, all the quant lines, the direction of the modified 15, and multiple other parameters. You could set up a dashboard for 100 different stocks. There is no limit to the number of dashboards you can create. Now, when all these parameters align, in other words, the markets come to you, you're going to get an alert signal. And that alert is an audible and visual orange flashing color on the alert. The alert is not an entry. It is not an alert to say jump into the trade. The alert is telling you. On Apple, the alert would start right here. Everything that you want is aligned in your direction. The quant line, background bias, the 50, the 15, price. Now all you have to do when you see the alert is bring up the chart and wait for an entry. So when you're looking at 100 stocks, 85 of those stocks are not going to be aligned appropriately and not going to be giving you an alert. If you're trading 20 stocks, most of those stocks won't be aligned and won't be giving you an alert. But when you do get an alert, you can bring up the chart, and that's how you can get in multiple trades in a given day by not having to watch any given specific chart. Now, it's up to you how you want to do it. You can watch Apple, you can watch Facebook, you can watch Google. The style that you trade with is totally up to you. What we do is we usually trade with 9 stocks, and I try to do a pre-market analysis and pick what we think are going to be very volatile stocks. Put up the dashboards and wait for the alerts. But you can just trade one stock. But if you do, you're going to have to wait for the alignment of all the time frames. And you can see right here, this is a great entry on Delta Airlines, but it doesn't have background bias. And unfortunately, we can't whine about it because it just doesn't meet our criteria, even though it's a terrific trade. And Delta obviously is not a very volatile instrument. And it may be that we don't get a trade on Delta all day. Let's see if we do. And we do right here. There's a strategy entry to the downside. Now the trade takes some heat here. It's not right off resistance, but then eventually it falls all the way down, all the way to the downside. Nothing really, though, stellar on Delta. Here's a trade. Here's an excellent trade. Let's see. Well, that's a strategy entry formatted as a dot. And here's your long trade on Delta Airlines, starting at 808. This is very strong background bias to the upside, very strong. You have your quant line, you have your entry, you have your 50 and your 50 to the upside, and everything moves to the upside. So if you're day trading stocks or futures, and you want how much of a move is this? This is 455 to 490. That's a 35-cent move on Delta, which is not a volatile stock. You're not going to get $1 and $2 moves on a $40 stock when the stock is Delta. You've got yourself a very, very nice move to the upside. And the risk to reward here is unbelievably good. You're looking at a risk of 6 to 7 cents on a potential upside of 35 to 40 cents. So the risk to reward is outstanding. Even though you should trade with 75% or greater wins, if you take 3 losses in a row and 1 full win, you're going to wipe out those losses. And that's how you want to trade, with a really great risk to reward. And stocks offer you that. This is only a 5-range chart. Maximum potential loss on this trade is 7 cents. Maximum upside is how you format your ATM. And you can take this trade. You're not going to get the whole move. It's impossible to pick a top. But you know the direction. And you're not going to get delta coming down against you. It's going to go up. This is why we can pick direction with such precision. If we wait for an entry where all our independent variables align, the dashboard's giving you the alert, you wait for the signal and trade in the direction that the software puts you, you're going to have a very, very, very high win rate. Now, that's really it. Just want to touch on one other quick thing. And that is this. All right, let me just run through these really quickly. Now, if you become a member of RightLineTrading, we will never ask you to pay for boot camps. We never ask you to trade for seminars or lectures. And every Wednesday at 1 o'clock in the afternoon, they've been running an hour and a half to 2 hours. I give a trading seminar on how to trade. And embodies a little bit about what I talked about today. But we go in depth on market structure and price action. We talk about the indicators. We go over traders' entries. We really go in depth on the software, but more importantly, in general, we go over how to day trade. And essentially, it's equivalent to a very expensive course on how to day trade and how to swing trade. Listen, and the difference between day trading and swing trading are just the time frame, whether you trade a 3-minute or you trade a 2-hour bar, or whether you trade an 8 range or you trade a 35 range. And the entries that you take are identical. The background bias is identical. Now you're going for a much bigger move, so your entries are going to come less frequently, but when they do come, they're going to run much, much further. And it's up to you to decide on your time frame. The software can be used on any time frame and on any type of candle. It can be used on Renko, range, time, or tick. It is irrelevant. And on the indicator packages, we give you free upgrades for life. If we improve it, we give you the upgrade. If we create an add-on that's directly related to it, we give it to you for free. So we don't take additional money, and these are all yours for becoming a member of our trading family. So for an entry of a very, very low price, we actually teach you how to day trade. Those 1 p.m. boot camp, the 1 p.m. seminars are awesome. And I'm not just saying that because I do them. They really are great. Now, 1 month is $399. 3 months is $999. And lifetime is $39.99. Now, this comes with the dashboard. If you don't want the dashboard, and you call and you talk to Rory, this will go to $299, and these prices will go down appreciably. But we're including the dashboard, and the dashboard is just a nominal additional price to allow you to look at multiple stocks without actually having to sit and watch the chart and wait for all the different parameters to align. The dashboard will do it for you. You can move it off to a second monitor and just keep one eyeball on it on the side and wait for your stock to flash an alert. And you can look at, I mean, what's nice to do is to look at stocks in different sectors. Look at tech, and look at non-tech. Look at, stocks trading in different sectors. One of those sectors is going to be good, but we don't care whether the stock goes up or down. All we're really looking for is volatility. If you want to trade Netflix, Google, Amazon, whatever, or if you don't have the money to trade those, if you want to trade less pricey stocks, you can pick whatever stocks you like. So let me just take a look and see if there are any questions, because we're going to stop here. This is us. It's RightLineTrading.com, www.RightLineTrading.com. Our email is info@RightLineTrading.com. Our phone number is 1-855-765-6681. Ask for Rory. And if you go to our website, RightLineTrading.com, you're going to see all of our contact information, and you're going to see everything posted. Now, right now, we're having the website redone. Our Forex package right now is off the website, and our stock package is off the website. So that's only because of the upgrade we're doing on the site. So we'll send you an email with the buy links and additional information about the software. So let me just take a look and see if there are any questions. Yes, Sam. Sam asks, you have shown us how the software works in a very short time frame. Will it work for a week? Absolutely, Sam. We have people trading daily bars. We have people trading 4-hour bars, 8-hour bars. In fact, if I would have whited out or covered up the time frames on the charts that I showed you, it would have removed no relevant information. So one second, Ron. I'm just going to finish Sam. So that it is irrelevant what the time frame is. You're still looking for all the independent variables to align. You're looking for all the signals to align. You're looking for an entry, and and when you get that, obviously the higher the time frame, the less often you're going to get a signal. But once you get the confluence, you're in. Absolutely, Sam. It's going to show you the direction of the market irrespective of the time frame. And like I told you, we have traders trading, because we have to send you a template, because an algorithmic system like this has multiple inputs, and you can't take the indicators and create your own workspace. We have to format it for you. So you just tell us what you're going to trade. We have a library of templates. If you want to trade a 4-hour, we send you a 4-hour template. And that 4-hour will work on any instrument on a 4-hour, where your trading chart's 4 hours. If you want to trade a daily, we'll send you a daily template. And if you want 3 or 4 templates, we'll send you 3 or 4 templates. We have them all formatted already in our library. We can't send you 100 templates. It would drive you crazy. But we have them all. So irrespective of, you can trade a 377 tick. You lost my, I think that might be you, Ron, because I'm still registering the audio. You can trade a 377 tick. You can trade any tick you like, a 610 tick, a 1250 tick. You can trade a 144 tick. We have templates for all of those. Tick, time, Renko, and range. Makes no difference at all. Now, Ron, they do only work on NinjaTrader. If you don't have NinjaTrader, you can download a demo. Good, I'm glad, Ron. And just to answer, I answered your question. I'm going to answer it again. The indicators do only work on NinjaTrader. We're working on Sierra charts. That's still about a month to 6 weeks away. If you want to test the indicators, you can get a free demo data feed. You can get a free demo of NinjaTrader downloaded. It does work. It does work on Thinkorswim because TD Ameritrade has an app that allows you to convert the signals and take the trades. So it does work on Thinkorswim, which I think is a great platform. And we've got many people on Thinkorswim. So that works fine. It doesn't work on TradeStation. There are a lot of it doesn't work on, but Thinkorswim is one where we can configure it for you. So that's really it for the questions. If you have any other questions, send us an email or give us a call. I'm telling you, this is going to show you. This is going to show you the way. The independent variables are extremely powerful. They're going to show you the trend, and they're going to show you an entry, an optimal entry. If you're just looking for a trending market, I mean, you want to trade off support or resistance, so you want to look for an optimal entry. But in terms of which direction, it's right there in front of you, and you will not get beaten up by this market. I'm telling you, and that's really the key. You wait for these independent variables. Let me show you. What do we not? Let's look at Perigo. Perigo is a generic pharmaceutical company. Now you can see that price is falling, not because the background bias is in pink because price is falling. Price is falling is because background bias has gone pink. There is no optimal entry here. But that's the trend. And that's where you want to go with Perigo, right here. You want to take it short. Now, when there's no time frame alignment, you'll notice how Perigo's in total chop. There's no time frame alignment, and there's no quant alignment. All the correlative markets are pushing money back and forth, and look what happens. And this is yellow, not because this is in chop. This is in chop because it's yellow and because there's no time frame alignment. This is when you stay out of the market. Remember I told you about the prevalence of a successful trade in a trending market? Well, there's no trend. With no background bias and no quant, you have no trend. And the likelihood of getting a successful entry here are zilch and zero. But here's a great entry, a perfect entry right here on Perigo. You just have to wait for them, and they come. Now remember, this is a fast time frame. Right here, it's a strategy entry, and you can see everything is aligned. Quant line is aligned, background bias is aligned, and I can find an enormous number of trades like this. You're not going to miss on the direction of the trade. It's almost impossible. And the reason you look for an optimal entry is like you don't get a short area of a move to the downside. On an optimal entry, that won't happen to you. And here, big area on Perigo of no quant, all yellow, and no background bias. And Perigo's untradeable. No entries, no way to assess direction. It's impossible. Now here's your long entry. Now this just misses an entry here, and you really don't get another one. That's your entry out of consolidation. You've got the quant. You don't have background bias, but because it just missed it by a candle. But you can see how it predicts direction. And you can't miss with direction. When the quant and background bias align, you've got it. Now, if you join and I teach you some of the more elegant specifics, you'll learn why this is a tradable entry and why you could have taken Perigo short here. But for right now, as far as we are concerned, these are not aligned. And I could really just go on, I could just do this forever. Because you're not going to miss on a multi-time frame alignment direction, and when the quant line aligns, it's going to tell you direction. So listen, everyone, I'm going to let you go. Call us if you have anything additional. Send us an email, and we'll send you an email very, very, very shortly. So I really appreciate you all coming in. Remember, if you don't want the dashboard, the prices will be $100 cheaper across the board. On whether or not we want the dashboard is totally up to you. The dashboard really is a nice trade analyzer, and it will show you the trending markets, and it will tell you with this alert that a trade is likely to appear. It is not an entry signal, but it's a heads-up signal. And that's the kind of signal you want. You don't want an alert where you got to run over and the entry's already past you. It tells you to bring up the chart, watch it for a while, because you're likely to get a trade. Okay, everybody, have a really, really great evening. Hope to see you aboard. No matter what you do, I really wish you profitable, profitable trading. We're out to beat the rest of the commercial traders, and we can do it. They counter trend trade. They call tops. They call bottoms. They trade a non-trending market. They make an enormous number of mistakes, and unfortunately, we capitalize on those mistakes by running them over, by trading a trending market. When they take a counter-trend trade, they help us out. They create consolidation by trying to move the market in the wrong direction. That's where you get a green candle and a red and a green and a red and a green and a red. And consolidation's almost always going to break in the direction of the trend. All those counter-trend traders are all going to get run over. And those are not institutional traders. They're commercial traders like us, trading the old way, the old system, oscillator divergence, MACD crossovers, and doing all the things they shouldn't do, caught in the wrong direction. So listen, everyone, great evening. Thank you very much. And you're welcome to give us a call, send us an email. And I really do wish you the best of luck, and that you really are profitable and you make really good money. So everybody, take care. So long.